Welcome everyone to Daily Mortgage Rates Live with the Mortgage Calculator. We'll wait just a few minutes here to get started to go live on all the different platforms. We are streaming this on YouTube, Facebook, Instagram, and LinkedIn. So just give us a minute to get live on all the different platforms. In the meantime, we do have the chat pulled up on the screen, so you can go ahead and drop a comment in the chat. I see some people are already dropping comments there. Thank you for tuning in early, and we'll get started here in just a few minutes. Hope everyone's been having a great week so far. Happy Friday. And going to be interesting to see what the rates are looking like today. So we will pull those up here in just a moment. Thank you for tuning in. I see people dropping comments there. We do have the comments pulled up on the screen, so feel free to drop a comment as you tune in. All right. Good morning, everyone. Good morning, everybody there in the chat. Looks like we are live on all the different platforms, so we can go ahead and get started. We'll go ahead and take the chat off the screen there, and then we will get into it. So welcome, everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. What we do here every day on this show is go through the live mortgage rates for different programs, and then we do a deep dive into a different topic every day. Now, today's deep dive is going to be one-time close construction loans. Now, yesterday we talked about doing rehab loans for primary residences. Today, we're going to be talking about building new homes by finding land and building new homes for a primary residence. So yesterday was rehabbing homes that already existed for a primary residence. Today is going to be building them off of land for a primary residence. So we'll get into that in just a few minutes. We'll have Jose pull up some examples of that when we do our deep dive. But first, let's go ahead and do what we do every morning here, and we'll pull up the actual rates for different scenarios, and we will see what it's looking like today. So, Nick, why don't we go ahead and pull up our pricing tool and see what the market looks like this morning?
All right, let me switch my screen, and we'll get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. This is going to show us the general rates and APR, including all the fees for our general programs. It is June 23rd, just after 11 a.m. Eastern, so most of our general programs are live. So we're going to put in a basic scenario here and check out all the different pricing. If you'd like a full loan estimate that breaks down all the fees that go into the APR, please get with one of our loan officers. We have over 300 licensed loan officers, and we can do primary second homes in 24 states. And we can do our DSCR business purpose in a total of 44 states. So a lot of coverage there. So for all our demos today, we'll set up a basic scenario as we do every morning, 400,000 loan amount. We'll do 80% loan to value. That means 80% loan, 20% down payment. We'll ask the computer to find the best rate at one discount point in cost. That's what price means. That's our typical request these days. And we're going to check out conforming conventional programs. Then we'll compare that to FHA. And then we'll go into our expanded guidelines, aka non-QM, where we have over 5,000 additional loan programs besides the standard. We do not do VA or USDA on the live scenarios. We might have a couple examples today for the one-time close, as we did yesterday. But remember, VA is only for our eligible veterans and active service members. So if you do happen to be eligible, let us know. We'd be happy to quote it, no problem, but not everybody is. And same with USDA, that's only for properties that are eligible in a USDA rural area. If you do happen to be shopping in one of those areas, let us know. We'd be happy to quote it. But for our demo today, we'll start with conforming conventional. We're going to do a purchase, 30-year fixed loan, standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we will use a 760 estimated FICO and a estimated debt to income ratio of 40%. So with these basic settings, as we do every morning, let's check out the conventional rates today. Little anticlimactic. Every show this week has been the same. So same rates, 6.875, 0.875 discount points. Final APR just a touch over 7 at 7.037. So remember, we compare APR, so that way we can compare apples to apples across the programs. So this is our most common option for conventional. A great option here, but many times a borrower may not quite qualify for conventional conforming. So the next option, let me click back into the pricer. We set up the same exact scenario. The next option we usually compare is an FHA option. FHA loans typically allow a little more leniency on credit type of events, and of course have a higher debt to income ratio. So typically if someone can't quite qualify for conventional, this is the next best option. We will keep everything exactly the same, and that way we can compare apples to apples from conforming to FHA. So it's about the same as it was yesterday, maybe a touch higher actually, 6.125 rate for 1 discount point cost, and a final APR here for FHA of 6.717. Remember, FHA does have upfront mortgage insurance and yearly mortgage insurance, so the APR actually takes that all into account. And in this case, in this scenario, if our borrower qualifies for both conventional and FHA, looks like FHA is actually a little bit cheaper. So definitely recommend our customers that qualify for both look at FHA, and those shopping and need to use FHA, definitely a great option now with the recent changes to the mortgage insurance there. Now, if for any reason our customer can't qualify for any conventional or FHA program, that's where we love to specialize. Many other banks or lenders don't have any other options besides the standard, but that's where we specialize here with our expanded guidelines, aka non-QM loan programs, where we have over 5,000 additional programs besides the standard. So we'll keep everything else exactly the same so we can compare. However, with non-QM, we get a new option for income verification. Full doc, let me scroll down here. Full doc is what we use for FHA and conventional. That is 2 years of tax returns. So typically we will select this option to choose a alternative income, such as asset related, business bank statements. We have investment property options for DSCR. We'll talk about that in a minute. Our most popular option by far is our personal bank statement option. We have RSU stated, VOE, 1099, P&L, no income options, all kinds of different variations here. But for our demo today, as we do every morning, we will check out the personal bank statement 12-month program. That's the most popular option for a primary home. And that's for our self-employed borrowers. Many times our self-employed borrowers submit 2 years of tax returns, have various write-offs and other things going on, and may not quite qualify at all, or may not qualify with as much income as they really like. So in this case, to solve that problem, instead of using tax returns, for income, we're simply going to use their last 12 bank statements, and we're going to determine a debt to income ratio, in this example of 40%, using their actual cash in the bank statements rather than their tax returns. So most self-employed borrowers will qualify for double, triple, quadruple the income when we actually just use their cash in the bank statements. So many times this solves the problem for many of our borrowers. So with these basic settings, let's compare the non-QM rates this morning. So remember, conventional was just a touch over 7, and here we have a non-QM bank statement option for 7.25 rate, 1.25 discount points at cost, and the APR 7.325. So again, as we say every day, we love when the non-QM options are very comparable to conventional, just a touch more, less than 0.3 more on the final APR to go from a conventional program to a bank statement program, which many times solves all of the problems for our borrowers. So we absolutely love these programs. Please get with our team. There are tons of variations. You can see we scroll down here, there's hundreds of programs. Some of these programs at the higher rates may allow things like credit events, such as a foreclosure or a bankruptcy, and other things. So not only can non-QM give us alternative income, but can also allow us to get around some other potential problems for borrowers. So great solutions here. Obviously, the rates are a little bit higher, but again, we're solving problems where a borrower would not qualify, and now they can qualify and get the home that they want. So these are amazing programs. Now for our final demos, we always want to do live pricing for investment properties. So for our final 2 pricing demos, we'll set this up to an investment property occupancy. We'll set everything up the same as it was before, 80% loan to value, 20% down payment. And we're going to compare our investment property options. Real simple here. We only have two. We have conforming conventional, and then we have tons of options under expanded guidelines. Remember, FHA, VA, and USDA are only for primary homes. So we're going to focus on these two right now, starting with conforming conventional. Everything else is going to stay the exact same as before. The only thing we have changed here is the occupancy to investment. So let's see what the investment property rates are this morning. So as we say every morning, they have added some additional loan level price adjustments, aka penalties to investment properties for these programs. So the computer is not able to find an option for one discount point. Great option here though for our borrowers that do qualify for conventional 7.375 rate for 3.25 discount points in cost and a final APR of 7.617. So these are great options for our borrowers that qualify, but most investors would like an option for one discount point, and unfortunately for conventional, we don't have that option, at least here at an 80% investment purchase. So many of our investors would like a higher rate in order to reduce these discount points. In this example, $13,000 is a lot of money. So to solve that problem, we want to check out our non-QM options. Conventional is going to always have that problem here. So for our final demo, we will do investment property, set this up the same, and we are going to select expanded guidelines, also known as non-QM, where we have 5,000 other options besides most banks that only have conventional. So we will set everything else up the same as our other demos, but we have to select for non-QM first the income. So the most popular option for an investment property by far is our DSCR program. And that's because it doesn't actually require any income or employment from our borrower. We're simply going to use the estimated rental income from the property we're purchasing in this example to determine a DSCR, that stands for debt service coverage ratio. So if the estimated rents can cover the debt service, the PITIA of the mortgage that we're proposing here, that is a DSCR ratio of 1.00 or higher, aka the property cash flows on a monthly basis. But we also have options for DSCR ratios under 1.00 as well, where the property doesn't quite cash flow on a monthly basis and cover the monthly expenses. So for the demo today, we'll just delete this. That way we can show all the options that show up. And the final thing for a non-QM program for an investment property, there is always a standard prepayment penalty. So we always price with 3 years. That's the standard. There are options for no prepayment penalty. That does cost more, and not all loan programs allow it, so we don't do that live. And same with 5 years, a great option if we want to save some money, but not all loan programs allow it, so we will choose 3 years for the most common option to show all the most common DSCR programs. So let's check out the DSCR purchase today. Yesterday it wasn't working, so thankfully today it is. Great option here, 7.875 rate, so a little bit higher rate. Obviously, we're going non-QM, we're going no income, we're going, totally the other end of the spectrum. Here, 7.875 rate, but we've solved the discount point problem, 0.975 discount points. Our investor is going to save $10,000. They can put into another investment. And the final APR here of 7.941. So remember, the conventional was 7.7 something. Here, we're only 0.2 away in the final cost of the loan. So most of our investors, if not all, that compare a conventional to a DSCR are going to go DSCR. These programs are amazing, very flexible. You can start 1, 2, 5, 10 loans at a time. So you can refinance multiple properties, purchase multiple rental properties. So much flexibility, no income, no employment needed. So very amazing programs, especially when they're almost identical to conventional. And we can get a little bit higher rate as long as the property cash flows in order to save our discount points. So solving a lot of problems here. Now, if you'll notice, all of these programs have different DSCR ratios, as I mentioned. They will have different prepayment penalty amounts if we scroll down here. They will have different variations on credit events, foreclosures, bankruptcies, things like that. They may have different things that allow short-term rental income at some of these higher rates. So please get with our team. We'll find the best option for you. So now let me go ahead and introduce Jose's deep dive topic. Let me switch my screen real quick. And Today's topic is going to be on one-time close construction loans. We're going to do conventional, FHA, VA, and USDA, I believe. You got all four ready, Jose?
Yes, sir.
Okay, cool. So let's real quick, let's introduce the topic. What are we talking about here? I know you weren't on yesterday, but we talked about the rehab versions. Remember that has a property could be all the way burned to the ground, but there has to have been a property there at one point, has to have been a foundation. Now we're going the opposite. Now for a one-time close, you can't buy a house that exists, right? We're talking about empty land where nothing exists, and now we're going to build something new to live in, right? This isn't for investments, correct, Jose?
Correct. So one-time close is a very special product because for primary and second homes, depending on the loan type that you're doing, obviously FHA, USDA, and VA is all primary. Conventional would allow second homes. What's very special about it is that it does allow you to purchase the land in conjunction with do your construction build, and then it does convert to the end loan. So that saves you a lot of transaction expenses along the way. If you were to have a separate land loan, then a separate construction loan, and then a separate end loan, theoretically, you could have those. That would be three separate closing with all those separate closing costs that would add up along the way. It does let you plan also because you know what your interest rate will be once everything is done, as opposed to if you start on that mission now, a year later, who knows what the rates could be. They could be lower or they could be higher, which tends to be the trend right now. So, but again, what makes it especially nice is that you can buy the land included, because normally, as you all know, land loans are very difficult. When you can obtain them, it's usually going to be sort of hard money type rates and hard money type loan to values. And in some case, you're going to be looking at 50% LTV, things like that, which could make it very difficult if you don't have the 50% down payment, even though, yes, the land could only be 50, 60, 70, 80,000, but it could also be 200,000, 300,000. And if you don't have that 50% down, then you're stuck. Now, one thing to note on the one-time close loans is that the borrower cannot be the contractor on the loan. We have those general contractor borrowers out there that are really excited, thinking they could build their own home and save tons of money. Well, unfortunately, that's not going to be possible with the one-time close loan. You could do that if it was an investment property, spec home that you're building. If you're an experienced contractor, they would let you build that one, but that is not for their personal occupancy. That is an investment property only. So you do have to note that you have to have your contractor already in place if you're going to apply for these one-time close loans, because the contractor is going to have to be vetted and approved. You're going to have the scope of the work already on paper, because you are going to have to provide that, which means you probably will need plans already, and preferably those plans approved. Because from my own personal experience, when I built my house, it took like a year to get my plans approved. It's custom-made home. And it was a long, drawn-out process with revisions involved, because once you get it and you look at it and you don't like something, you're going to send it back to the drawing board for updates. And you really can't be already into the loan and doing that kind of work. So you do have to have your plans set. Doesn't mean you have to have the individual permits approved, but you should already have those plans ready and approved. So there is some upfront planning that does go into these things. You just can't get up one morning and say, you know what, I'm going to do a one-time close loan and do it and expect to be able to close that loan anytime soon. They're not going to let you close it until those things are in line. So let me give you some examples here now on what is possible. So we do have a conventional one-time close option, which does let you go up to 95% LTV. Now, mind you, yes, you will note rates are a little bit higher, but just keep in mind what you would be facing, the 3 potential closings and transaction expenses if you were going to do this as a separate transaction. So 9.625 is the lowest rate option, and 9.625 is the lowest cost option, and 8.875 is the lowest rate option. And that is 95. Now, if you go 90 or 80, you will have obviously lower interest rates, but this would be best case scenario, highest LTV, which in my experience is what most borrowers would like to do. Maximum leverage, low minimum down payment. So our FHA one-time close option does let us go up to 96.5% LTV. Rate is a little bit lower. The conventional FHA, there's a lot of volatility right now in the market. So these products are higher risk products. And what's basically happening here is you got to remember this rate is going to be good for a year, 1 year out. This is like locking in your interest rate for a year. So there is some additional cost built into the rate for these situations. So here you're looking at 9.125 as the lowest cost option, and 8.5% as the lowest rate option. Now, on our VA, they do not have that situation going on internally. Apparently, there's some more favorable market factors here for VA one-time close. So you see that the rate is 6.75 as the lowest cost option, and 6.125 as the lowest rate option. So for those of you out there in those VA type areas where normally maybe a little bit tough if it's an overheated market, existing inventories tough to get, you're looking at 100% LTV financed offer competing against 20-30% down conventional offers. Maybe a little tough to land already existing inventory homes, but look at the one-time close as an amazing opportunity, as an option to offer to your borrowers or prospective borrowers that may be a little frustrated with being able to land the deal. Well, then just get them a piece, have them get a piece of land and build the home of their dreams. No frustration there. Just get the land, get the builder, and build your home and get great rates. And the same with USDA. Normally, USDA may be a little bit difficult in some cases to land a deal because it's 100% LTV financing. But again, look at these amazing rates for the USDA one-time close at 100% LTV. So it's an amazing option. 6.75% is your lowest cost option, and 6% is your lowest rate option. So again, you have to look at these loans as an opportunity to get the deal that they may not normally be able to get for the USDA and the VA homes especially. And the same is going to hold true for FHA and conventional. Inventory is tight in most markets out there. Most borrowers may not know how easy it is to be able to do this. Most of them would love to build the home of their dreams. So it's our job to empower them with the information and make their dreams a reality.
Beautiful. I love it. Okay, cool. Well, let's go ahead and wrap it up then. I don't see any questions. Remember, we do this show at 11 a.m. Eastern time every weekday where we go through the different rates and do a deep dive into a different topic. Today's topic was great. And remember, you can go search for yesterday's topic, which was rehabbing these loans as far as conventional FHA, VA, and USDA. So thank you, everyone, for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all on Monday, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Take care, everyone.
Thank you, everybody. Have a great day.
Thanks, everybody.